Welcome to Swimming with Allocators. I'm Ernest Sweat, and each episode, Alexa Benz and I give you a VC podcast from the LP perspective. You ready? Let's dive in. On today's episode of Swimming with the Allocators, you have us. You have our hosts, Alexa Benz and Ernest Sweat.
Hey, yo.
Yes, let's do all college radio. What's up? It's yeah, we're elder millennials. We have to do that. But in this special episode, it's called DDQ, where we discuss, debate, and question what's going to happen in 2024 and what we've seen in 2023. DDQ is something, usually it's due diligence questionnaire that, all of, emerging managers, established fund managers have to deal with
the freaking beast.
Yeah, long documents. But for us, this is going to be a fun, condensed conversation where we bring in our opinions and what we've seen, throughout our career, and especially over this last 12 months. But also what we've heard and haven't heard in all of these interviews on Swimming with the Allocators. So, Alexa, just really happy to jump into this with you. And anything to add?
I think something that's been interesting is some people are super on board to come on the show and share publicly everything they're thinking. And some people have actually preferred to do one-on-one chats offline. And so I think this is a nice way for us to be able to share too, sort of the compilation of some of the anonymous conversations we've been having that are behind the scenes.
Absolutely. So first, with that, let's start with discuss. There's been so much. We want to just start with all the things that have happened in 2023 and the lessons learned. And so just a few things that have happened in this year. Also, as a side note, the 20s have just been too much or three much, as sometimes my friends growing up would say, and getting towards four much of a decade. It's like I miss the 90s sometimes, where it's just like up and to the right, and we ignored things. But just a few things that have happened so far. Gen AI has become a household name. Not only you have known, your little cousin, but also your grandmother has probably used it at this point. We've also had substantial banking changes for the startup community with some bank runs and just now startup banking being kind of like democratized to a lot of different established banking communities. Third, major tech companies started off the year with huge layoffs, and we've seen layoffs throughout the year from startups to big companies like Meta, Google, Microsoft, and Amazon. Fourth, big, we're all in VC for acquisitions and exits. A big one got broken up, Adobe and Figma recently. And then lastly is after getting into this hopefully post-pandemic economy, where does that leave us with remote work and headlines of like Zoom, which benefited from the remote work, even asking its employees to go back to the office. So
it's extremely meta.
Yeah, it feels like a Black Mirror episode. But
they're like, this tool's not that effective, so we're going to stop using it.
So those are kind of just the headlines. Alexa, what's kind of been some of the lessons learned from your perspective?
Yeah, I think something that has started to happen in the back of my brain as we have these conversations with different LPs in different categories, whether that's, your high net worth individuals to your fund of funds and endowments, is kind of mapping how many slots they each have on an annual basis. So I've got this sort of like plot forming in my head. And what are those limiting factors that determine how many slots a given type of LP has available? and how that could help you sort of strategize how you should be spending your time as somebody who's GP fundraising. I had no idea that apparently every VC that was pitching founders was bragging about how Mark Andreessen and Chris Dixon are LPs. And that's a great example of a category of LP, like a Series A and later investor who wants to get access and early looks, who really has no limit to how many slots they're gonna have a year. And a cool young upstart can come through and they're gonna toss something in because to them, there's only upside. Versus some of these folks we've been having in private conversations who are managing public money. The limiting factor is it turns out it's really not check size. It's number of opportunities to get a decision made. And so
Yeah.
I didn't really quite have, I guess, a full empathy for why somebody who is presenting the investment committee's recommendations is it really has to come to the table with something that's a clear yes. Like you're getting 3, 4, maybe 5 opportunities a year to have the board review something. And anything that feels like a little bit risky or kind of new, there's a good chance that's going to waste one of your slots.
For me, one big lesson has been how big of a moment in time in the venture capital asset class it is right now, and how a lot of things are changing. And part of it is like, I don't know, there's this surrealness, I'll just speak for me, of being in a moment and being like, am I making too much of it because it's a new experience? Or is it really that big and a lot of things are changing? Or am I a millennial and in high school I had 9/11 when I started working, the Great Recession started. And when I had kids, I have the pandemic occurred for the first time in 100 years. So it's like, are we the new silent generation? That's another thing that comes to mind. But I think after having a lot of these, both interviews as well as the private conversations, I was validated. There is a lot of things changing. And specifically for allocators, no matter if you're a family office to, large endowment, public pension plan, things have to change because trying to find that alpha for the next 10 years is going to be different than the previous 10 years.
Yeah.
Where we had low interest rates, where there was kind of like a more private equity approach to venture, where you were doing financial engineering, and kind of these road shows to get bigger rounds without having the fundamentals. And now allocators understanding, no, we need to find true alpha that can of fund managers that can find the best companies that also not only can grow fast but can have sustainable business models. And so that changes your diligence of what you're looking for in fund managers.
Yeah. Are there points where you were sort of having to read between the lines at all on any of these interviews? Like what hasn't been being said that's just as important as what's been being said?
What I have heard or read between the lines is people want to hear conviction. They want to see discipline because we were, generally the industry wasn't as disciplined, shorter diligence times, deploying capital at a faster pace. So when you, as a fund manager, whether you're taking over a fund or establishing your own fund, what are you confident that you're good at that nobody else can really F with you on, right? Not what you think you want them to hear. And so my view was always like, be self-aware, be confident that nobody can out Earnest or out Alexa you, and find your ICP, your ideal customer profile. And so that's what I think I'm hearing from a lot of these allocators is like, what are you good at? And then you can't control what my portfolio already looks like, and if I'm overweight in what you do.
Yeah.
So
yeah, no, that's fair. I think I felt a genuine, maybe it's because these are the people who are agreeing to chat with us, but I felt a genuine, like, nobody here is trying to time the market. They're all venture bulls, which was, I guess, a little surprising to me because I was expecting to hear a little bit more of like couching or, bonds are really like you returning 1.6 or X right now. Like I was sort of interested to hear that they're not backing down. And Roxanne Guggen, who's this futurist we had on the show, she ended up following up with one more thought where she was like, wait. I gotta say one more reason why venture is the place to be. and the TLDR is like, you have no real choice. That I'm summarizing here, but it's Roxanne's words: cash is trash. And inflation has everything going down in value. So if you believe that legacy companies, if you're just putting everything in the legacy companies, then you're in danger in the long term. And the only safe place to go, the only thing that isn't risky is change. And the way to invest in change is venture. I hope that you all also had some key learnings or takeaways from listening to the past episodes with our allocators, and would love if you're interested in sharing those with the community too, what the biggest takeaways were for you for the year. And now let's transition into the next section of the DDQ, the second D for debate, on the big, bold predictions that Ernest and I have for 2024. We'll see if we agree. I'm curious to hear, Ernest. What is your first prediction?
Yeah, I'm excited to see too. We have not shared these again with each other. So this is off the cuff and edited, but whatever. So my first bold prediction is in 2024, there will be more spin-outs of VC funds, but they're going to come from larger funds and established funds, those individuals. And then a kind of slash to that is there will continue to be a VC free agency happening in 2024. So you'll start to see in your LinkedIn a lot of principals, partners, GPs moving to new firms or leaving the industry as a whole. So that's my first bold prediction in 2024.
Some quiet quitting. Okay. Counter to that, if you're at a place that's got major brand recognition and the LPs are all lined up, they're all competing to get into the top decile funds, what's motivating you to make this the year that you want to go raise on your own with a no-name branded fund?
Great counter. But I have anecdotal private conversation data. So, I think we've seen this with individuals from top firms already in 2023 doing this, but I think it's a combination of a lot of different macro events and then micro events as well. So macro, we've seen the slowdown despite the dry powder at a lot of these established funds. And so if you were promised that you had 3 bullets every year, and now it's been cut down to 1 essentially every year, that's
high stakes.
Another, that's high stakes. But the analogy that comes to me is like, if somebody gets, I know this is going to sound stupid, but in college, I never understood how my GPA with 1 grade could fall harder. But when I got a great grade, it was like, And so obviously I know how that, but that's like, I think that's the feeling that a lot of people have is like, I started deploying, if I'm a junior partner or early GP, I started deploying in 2015, 2016, or more likely probably 2019 and up. And my track record isn't that great, or I wouldn't, even if it is, it's shaky on some of those investments.
Yep.
So all
Yep.
that's happening with capital tightening, right? Of all allocators being a little bit more like skittish on re-upping. And so if I can't deploy and I have a great track record, not to mention maybe my management partnership is coming to me and saying these next 2-3 years are really critical for you, and you
Right.
need to, and markups, just any markup doesn't matter as much. We need, returns. And
Yep.
so
Time
that
to
puts a
deliver.
lot of pressure on those individuals. And this is a get rich slow game. And so if you don't have the comfort and the ability to like actually invest, and for every decision, make that decision based on that decision and not on previous decisions, and having that bias, um, then you're not, you can get lucky, but you're not really set up to succeed. And so I think all those things are happening where people feeling like if they have the backing, if they have some LP relationships, it's probably a good time
Interesting.
to spin out. And LPs are looking for new relationships. You also have a lot of established LPs, fund of funds. Not mid, I won't say it's the majority, but a lot of confident fund of funds have told me that they've left some of the biggest names in venture because they don't believe in the models anymore.
Yeah.
And
They're in every, they're investing across everything, and it's just, yeah, it's not focused enough. Interesting. Okay. I have to say, I think I had almost the exact opposite prediction, which
okay,
was if you're a Series A investor or above, and this is going to be an interesting thing to ask you because this is where you play, not where I play. I think if you're a Series A investor and above, the world is going to be your oyster in 2024. And so you may as well stay where you're at because I think you're going to get back up to 3 bullets. Whereas I think if you are a pre-seed or seed investor, which potentially is where you end up if you go out and you try to raise your own fund, just by what you're able to raise, I think seed is going to absolutely blow in 2024. And my reasoning here is that tech disillusionment is super real. Like the number of people who were coming out of Hotco, startup unicorn, who had seen a company go from 0 to 100 and had the lived experience, the teammates, and sort of the real life experience of what a VC scale company requires. Everybody was willing to do it. They were like, I'm quitting this job at Uber. I'm quitting this job at Slack, and I'm going to go raise because this is exciting. I want to own 50% of this instead of 0.5% of this. And now all of those really driven people have seen their equity worth drop in half, right? SVB, one of our killer partners on this show, has an biannual report, and it came, I'm going to quote, if 2021 unicorns were marked to market based on 2021 IPOs, we would expect their total valuation to fall from 900 billion to around 550 billion. So that's your net worth potentially has just on paper been cut in half. And you're still just as smart, and you still have all those technical buddies. And so I think the people that we used to be able to invest pre-seed and seed in are not going to be coming around passing the hat. If anything, they're going to decide, yes, I can build something myself, but I don't need VC. And those guys are going to sit in a room and just code on their own and bootstrap until they have a killer product and they own 100% and they didn't give us a chance to get in. Or they do have a VC appropriate business, and then it's going to be freaking dog eat dog to get into those repeat founder or, killer team deals.
Yeah.
Like everybody and their mom is going to be fighting for the same few deals that actually have teams that know what the fuck they're doing. And alternatively, the people who just haven't had exposure and like haven't had, like if you know, you know. If you know, you're not necessarily taking VC. If you don't know, you still think this is a great idea.
Yeah.
And those founders at the pre-seed level, the seed level, they are delightful, they are coachable, but they don't know what the fuck they're doing. And it's a huge lift, and they're going to make a ton of more mistakes along the way. Everybody prefers to invest in repeat founders than new founders, right? So it feels like when I was in college, and everybody, this is at Stanford, we had just seen the bubble burst, the tech bubble burst. No one wanted to go work in tech. This was in Palo Alto.
That's insane.
And so, like, if you know, you know. So my argument is Series A and above, 2024 is going to be best in show. You're going to get to pick from the best in class. Pre-seed and seed, I think it's going to be like going to the pound.
So my counter to that, great points. You were cooking, so great points. But my counter to that is, I think it's always a discussion in VC and America is the have and have nots, right? So I think those that, and this is going to be to my second point, I won't give it away, bold prediction, but I won't give it away yet. But the counter is, I think those in A and above that have capital will be able to have their pick. But I think founders are going to get smarter on who they partner with and what value can you actually add. So that's to that point. To yours on the core of like seed, and I agree with a lot of your points, but I think we've also seen this movement of Gray Croft going earlier, right? And Andreessen going earlier, and Greylock doing a essentially like almost accelerator program, incubation, right?
Yeah.
And so there's going to be a lot more capital there. So I think it might continue the disillusionment. And you're going to see, which was really, if you looked at the beginning of pre-seed and even seed, when we both kind of got in the industry in 2015, 2016, there were a thing called parting rounds where a lot of people got involved.
Totally.
Those aren't really going to happen anymore. And I think it is going to be just as competitive as you mentioned.
Yeah.
Again, but like my counter is that
Andreessen
there's still going to be a lot of money.
Totally.
Yeah.
Yep.
Yeah. But it was a great lead into my second bold prediction is I believe there's going to be more consolidation in the VC ecosystem with us seeing more situations like OpenView, which, that sucks for a lot of those people. There's this hard situation for a lot of people who, built their career up and just disappears. I think there'll be more situations like that. And then also ones that you won't hear about that will be kind of zombie funds. So people who were going from fund 1 to fund 2 and can't do it, fund 2 to fund 3 can't do it. And I've heard a lot of times
or just choose not to.
Or just choose not to.
They have a lot of ideas. They're going to go like build a retreat center in Mexico instead.
Wow. That post-economic life. So as we dream of. So I think that's going to happen a lot. What's kind of your view? I think that's what we've kind of heard from the allocators too, as we interviewed, right?
I'm an LP in one fund that's on its second manager. And
that was deep. That was a lot.
I'm curious. I'm curious with those zombie funds. What's the opportunity? Is that, do you sort of assume, okay, X number of hours a month, I can continue to kind of just like keep tabs now that the fund is deployed. I can half in, half out, do my job, do my LPs a solid and like keep one eye open watching these? Or Or do we see sort of like the secondary market come in, or is there sort of like a third party service provider that doesn't even exist yet that takes all of those ex Facebook PMs portfolios off their hands so that they can go back to working at other companies? Like, I think you raised a fund, you figured out what actually being a VC is, and you're like, oh, it's not just investing. Like there's other just like headachy stuff. I don't really want to do it. Is there a role for like an outsourced GM who tries to actually like create value with the things you've picked? Because I think it's pretty lazy to assume the job is done once you've put the capital in.
Yeah, although a lot of people do. So I think the results are going to be secondary markets continue to, a lot more interest happens there. From what I'm hearing at people who focus on that, there's a large LP that I advise that does a lot of work in that. You're starting to see some corporates who had LP positions in VC funds start to kind of go away from those in pretty significant positions. But other than corporates, they're seeing not as much kind of like meeting the mark on price on the discount from most investors. And you would think that a lot of the kind of like, especially for emerging managers, a lot of their family offices and high net worth individuals who have invested, they would want some liquidity, but not for the pricing that they've seen out there, which I've heard has even been as steep as, 60, 70% discount. So.
Yeah, no, it's a interesting point that secondary is basically, they're going to be picking among the things that are on sale for the most part, or, they want access to some of these things that are still pretty damn hot. How much time does it actually take to manage a zombie fund? Maybe this is easier than I'm thinking it is.
It's probably it's probably one. Yeah, without getting into too much detail, it's probably one person kind of managing a few hours on it.
Yeah.
And it's really just kind of the legal documents and manage of like, okay, totally. If there's any kind of proxies.
And you are zero value add. You're just admitting, you're like, we don't pick up our phone for our founders.
Yeah. Well, there's plenty of live funds that have that approach too if you're not performing. But let's moving on. What's your next prediction?
Okay, next bold prediction, 2024, is based on this kind of trite laundry list of companies that everybody points to when they say, well, you know what companies came out of the last recession? Airbnb, Netflix, Uber. You've definitely seen this quote, I'm sure.
Yeah, I don't think those people have seen the stock prices of those companies too. But go ahead.
Well, yeah. Apart from Nvidia, you don't really want to own much right now. The thing those companies all have in common is they all started as B2C, and so my bold prediction for 2024 is that if you don't have as an allocator some exposure to smart consumer investors, you're going to miss out on the biggest winners of the 2023-2024 vintage.
Wow, that is, I see the limb you're on and it's like shaking. No, this is great because, I'm like Mr. Not cool enterprise investor and you're a consumer. I get it. You're
enterprise has been where all the cool kids have been at. Like, I don't want to point fingers, but 2021, 2022, those enterprise investors got real smug. And
yeah, they started wearing Jordans. Are they just like, as a kid, I never had any. And so now I see all of our generation as adults. I'm like, do they just make more now? Like everybody has Jordans. But anyway, go ahead.
I'm going to post to our Twitter this amazing breakdown of what Sam Altman wears on a day-to-day basis. And it is fly. Talk about like this guy, #1 fashion influencer of the year. Sam
That's
Altman.
hilarious. So
I think I get it. You're picturing, when you hear consumer, a lot of people they picture Allbirds and Casper, and you're like yawn yawn yawn. No, I'm picturing like Meta, Apple, and Pinterest.
yeah,
And no way people know Pinterest is a $25 billion market cap company. It's like, you're not using it. That doesn't mean it is a cash
yeah,
cow.
yeah.
um, I think there's a lot of good arguments for why enterprise instead of consumer.
Can I go, or are you still building your point?
No, do it. I want to
Okay.
hear your
All right.
arguments.
So I wouldn't expect anything else from you as your bold prediction, and I understand it. But my counter is, I think that the enterprise smugness over the last like 5 years has been a particular type of investing in enterprise. It's been enterprise only for the software industry. So it's been SaaS for SaaS companies, infrastructure for SaaS companies, cyber for SaaS companies. And 81% is like my whole thesis, right? 81% of GDP is outside of software industry.
Yeah.
And so I think there's a lot more.
You know where that is? You know where 70% of that 81% is?
But the other thing is, I think there's a blend between, like you mentioned, I think there's a blend between what happens in consumer and then it goes into small business to mid-market and then enterprise, right? There's expectations that change. So it's a little bit of that. And so I think there's a lot more opportunity. Like, I'm really bullish on the fact that I think that we're going to have a new enterprise, or just in general, B2B tech renaissance that's going to be outside of the software industry. So that's one thing. My smug answer at first rebuttal was going to be, yeah, if consumer is like where it's at, why are all my consumer VC friends now digital health tech investors?
No, I think it's because the LPs like have not been. They don't agree with this thesis. Mm-hmm. But to just put a little seed in your brain, listening allocators, I do think this is a hits-based business.
Yeah.
And you'll hear from the enterprise investors who you should be investing into is it's great. It's not a winner-take-all market. You know, there's a bunch of us that are going to win. And I'm like, oh, great. So you're limiting your upside. You're like, I'm going to just bet on bronze medalists, right? Like, I don't need to win the race. Why not give yourself a chance to get some gold medals, right? These companies are bigger. And even if they are winner take all models, like, you have a chance to get in on these on the ground floor. Put a couple in your fund. Like, put a couple consumer, make some bets there.
Yeah. Enterprise investors, you heard it. Alexa called us Canada in the Summer Olympics. So anyway, no, I agree with you. I see your points; they're valid. So that brings us to this interesting, because it brings to my next bold point. I think AI's next step is going to be verticalized applications. I think that's what's really going to create a moat. If you look at a lot of the, OpenAI and other large language models, there's this kind of debate on like who's going to win. Is it going to be open source? Mm-hmm. Is it going to be these proprietary? And really, it seems like technology can't be a moat anymore.
Yeah.
And so either you own the proprietary data sets, or
which
like I'm saying, and
other people
which
own
you
that.
don't. Exactly. Or I think the other thing is like you own the relationships and the actual ecosystem. And so that's why I think we need to bring this technology to industries like real estate and insurance and retail that are huge. Mm-hmm. And so that's my next bold prediction.
Can you paint that picture for me more of like what that looks like in real estate? I am your eager student, Ernest.
I think there are so many industries like real estate. Like, I think of my prior, one of my prior employees when I worked in the industry, the number of people, and this was a corporate, right, that deal with corporate clients, they dealt with so many different people touching a lease.
Mm-hmm.
And it's like, do you really need 7 people touching a lease and doing this? And so
Yeah.
are there a number of the workflows that can be automated?
Totally.
I think that's the biggest question.
Yeah. It's super interesting, but I feel like there is a disconnect. If you are building for AI, you're like so passionate or interested in like the future of AI and probably just genuinely not that curious about signing leases.
Yeah.
That I think a lot of people are interested in solving these sort of like, this tool can be used in any case. And they put it on you to figure out how you make it applicable to your job or your industry. And I do agree with this prediction that there's a lot of upside for those teams that are willing to go like figure out how this is helpful for a very specific customer.
Exactly. It's going to be about going to the customer. Yeah. What's your next bold
I got
prediction?
one final bold prediction, okay, which is the hat Ernest is wearing is going to be the most sought after look of the season. Should you be
of all of 2024
in supporting what we're doing, you can pick up Swimming with Allocators dad hat at swimmingwithallocators.com.
That's a great way to end this section. With that, we'll end with our last segment, which is questions. So moving in to next, we've fielded some questions from our audience as well as some friends. And we're going to give our opinions on those. We would love for you all to, like, if you disagree or agree, let us know on all the different social media channels. So first, we'll start out with a question from our friend Jenny Fielding, partner at Everywhere Ventures. She asks, or she mentions that I've heard of 2 VC firms that closed funds in 2021, but recently asked LPs to reopen those funds to add more cash and extend the investing timeline for a few years. Basically, in other words, they look to dilute the frothy investing decisions and valuations of the earlier vintage. Alexa, why do you think, how common is this and why do you think it's happening?
Totally. I think extending the investing timeline is super common. I've been asked to sign off on extending the investment period of at least one LP investment. Makes a ton of sense, depending on where you are in the, food chain. I don't know how common taking on more cash is. I think the argument for it potentially would be it's a lower carry alternative to opening up a brand new fund. Like, why go out to market? And LPs may be down for that. But the 2 examples that I was able to find, Thrive did open up to more capital. And I think this is a case of you've got to have something like pretty juicy to offer. So Business Insider had published one anonymous story of a major endowment the story came out in Feb, saying they had to mark down Thrive's 2022 fund 30%. And then September rolls around and CalPERS has put in another $300 million. And maybe you're scratching your head and you're like, what is going on here? But they are a major investor in OpenAI. So the 2 examples of this that we've seen that I know of, Bedrock and Thrive, both have OpenAI in the fund.
Yeah, I think it's going to be those special situations. And I think it has to be with somebody who has, it's not everybody is going to be able to do this. It's going to be an exception versus kind of the norm. And you have to have some cachet from experience as an operator or investor or both to be able to kind of propose this to current or new LPs. And I think ultimately the kind of human nature behind why LP would do this is because they either want to get some more position in that fund and have more leverage for the next re-up, or if they've never been in this fund and want to do it. So
totally. Like, oh, you're calling me back? Great.
Yeah. Everything
Don't be so thirsty. Don't be so thirsty. Okay, next question is from Michael Ashley Schulman, who is the Chief Investment Officer at Running Point Capital and recorded an episode with us. If you haven't heard it, check it out. And he asks, okay, what's a question allocators should be asking the VCs they're chatting with and don't or forget to?
One that I've heard that I'm not sure most ask is, what do you see for the future of the firm?
Mm.
And I've heard this as kind of one way to get filtered out very early, especially if it's a new relationship, primarily if it's a new relationship. And let's say the situation is Alexa's raising a seed consumer fund, and the pitch is that she has a $75 million fund. And she answers this question as, oh, in 5 years, we're going to have an enterprise partner. We're going to have also like this huge opportunity fund or just a growth team. And that leaves you uneasy because you're already making a huge bet on this new entity.
Mm-hmm.
To then like expand that scope, you should see it as like a whole new entity every time you expand.
Yes.
What people want to do is like double down and triple down on your already experience. Mm-hmm. So by the time you get to fund 2, fund 3, fund 4, you've learned a lot of the mistakes and you should kind of be at your superpowers.
Yeah.
So
yeah, fill the slot like you're in a slot. I think another good one to ask is, what colleagues of yours would you invest in? Mm-hmm. I do know my lane, and there are people who are so good at the stuff that I'll never see, I don't have access to, I don't have a reputation for, and so those are some of the GPs that I have put personal checks into, are people who are doing something that like I know how hard this sport is, and like I am investing in that guy. Like that's, I think, that's some good recon.
And lastly, I think for established fund managers, or if it's an emerging manager that's, in older Gen X or boomer, so both situations, it's critical allocators ask, what is your plan for generational change? Because allocators
it's
want
longevity.
to invest.
They're going to be pumping our blood into them. That's the point.
Yes. Do you have a plan to be a vampire, or do you actually have a succession plan?
Because I did intern for a bit at an organization where none of the partners ate lunch because they were all fasting. And so they would have lunch meetings with founders where the founders like pretty much are supposed to be talking most of the time, and had like a lunch delivered, and all the partners have no food because they're all on the longevity kick.
Have we ever talked about this? I'm like a huge faster, but not for like longevity.
So
it's just like
definitely give your money to Ernest because he's going to live forever.
I am 53 years old. No. So I think that's a critical question though to ask Alexa, because as I mentioned earlier on this episode, so much is changing, and you should, as an allocator, want to invest in a franchise that's going to be around for a minimum of 4 funds and up.
Yep.
Next question is from our friend Zaz, a partner at First Mile Ventures. She asked, do LPs expect to see DDQs from emerging managers with sub $100 million funds?
Yes. I from my experience, I've been with funds going from like a $20 million fund to a $60 million fund, for example. I think the DDQ, especially if you have multiple partners who are out fundraising, is something that you should pretty much freaking just use to agree on how you're answering questions, no matter what size you are. So it doesn't necessarily have to be a public-facing document, but it's literally the questions that the investors you're talking to are going to have for you. It's just at whatever size you are. And a good third of them literally won't apply because you're like, no, we don't have this and that type of insurance yet, etc. So I think you may as well just start a DDQ document, no matter what you're going out to fundraise for, and eventually it'll get filled in the bigger you get.
Yeah.
But that's your reference document to make sure you're all on the same page.
Absolutely. So it's more internal, like just so you if you want to have your answers straight and have each individual who's in the founding partnership answering the same way, maybe in different flavors, but the same core answer, it's critical to have that. That's true.
Yeah, you're like, oh, we are setting down to figure out what our strategy is for Fund 2. You're like, look at the DDQ. It's going to help you outline like what are all the things we have to decide is our strategy. Final question. This one was anonymous in our DMs. Will the founder and GP ranks of diversity continue to be diminished after the #MeToo and George Floyd's murder?
Yeah, this is something that I've been thinking about as well as like observing. I was a founding board member of Black VC, and so it's something that I'm really attuned to. And I think organizations have emerged like Black VC, Latinx VC, and All Raise that have promoted kind of like, hey, this is an issue, and I think they've stayed on top of it. And I think we've also seen the ranks of entry points, whether it's analysts, pre-MBA, post-MBA, mid-career increase. But the worry is that the actual check writers and leaders of the fund, I'm starting to see a lot of those people spin out or move from different funds, whether they're female investors or underrepresented communities. And so it feels like we need to get back onto this issue and have a combination of not just people starting their own funds, as we've outlined today on like how important and challenging that is, but also be in the ranks of the established funds too.
Totally. No, it reminds me actually of an interesting tribute article that was written to, I guess it was when Sheryl Sandberg was retiring. But it was like there was an era in tech where suddenly we had these female execs. And it was exciting. It was like, okay, this is the beginning of a new era where we're going to have everybody running companies. And then you saw like Meg Whitman retire, and like no one came up after them. It was like a blip. And so I do think it's naive of us to think things are always getting better.
Yeah, I think progress generally goes like that. I did a hand motion in the audio medium, but essentially it's not as always go straight forward.
Ernest just did the worm. You all couldn't see it, but he was way down on the ground.
Yeah, exactly. So that ends our first DDQ episode. Thanks so much. We want to thank our sponsors, Gunderson, Pass Through, SVB, Canopy for their support and supporting us before we had one episode recorded. I want to thank all of our friends, listeners, other swimmers, still workshopping that name, but want to thank you all for joining us on this journey. Continue to subscribe and share. And then I personally want to just thank Alexa for going on this journey, taking this
a significant ditto,
coming up with this amazing name that people either love or hate. Thanks for co-hosting this with me, and look forward to sharing more episodes with everybody.
Thank you all for being part of this with us. Thanks, Ernest. See you later, Allocator.
After Portfolio Tile, Investing with a Smile.